Let's talk money.
Hello and welcome to Let's Talk Money. I'm your host, Surabhi Upadhyay. Well, it has finally happened. Yes, the budget has heralded the onset of a brand new capital gains tax era, one that promises to be simpler and clearer. But like most transitions in life, this change from old to new has also caused a fair bit of confusion. So today on the show, we are aiming to demystify what the new normal means across your investments, whether it's shares, equity mutual funds, gold, hybrid funds, and of course, real estate. We'll get to the long and short of it all. Joining me to help us with this task are Mohit, CEO of Moneyfront, as well as Srivatsan, Chari, co-founder of ClearTax. Thank you, gentlemen. It's great to have you, Mohit, here in the studio because I've, as you can see, old school style. I've got my paper and pen out because it's so complex, right? Absolutely. And Srivatsan joins us all the way from Bangalore, so welcome on the show. Before we get started, I want to take sort of broad thoughts from both of you gentlemen because we have this new regime where a lot of asset classes are getting clubbed. There's one big rate of 12.5%, the long-term rate. What did you make of the announcements, Mohit?
Look, as you rightly said, Surabhi, no change is ever easy to accept and take. My sense is this is a change which is a little painful in the transition era. But once you complete this financial year, I think it will be a smooth sailing. They've made it very, very simple, honestly. There are only two tax slabs. There are only two tenors. It's only 12 months or 24 months. There is no 36-month kind of a tenor. And then there are only two rates, which is 12.5 for long term and 20% for short term in case of equity or otherwise slab rates, right? So there is, it's become absolutely simple if you were to look at from that lens that going forward from next financial onwards, simplicity is the mantra. However, if you are holding existing things, existing funds, then yes, there is a lot to study.
Which is why you need to be patient, get your own paper and pen or iPad or whatever it is you use out and take notes because it is that kind of a show. Srivatsan, what's your sense? I mean, what do you think? I think the industry, investors, everybody was asking for an overhaul, right? We've got one. Is it good?
I think, like Mohit said, it's simplified, but the rates have gone up in terms of reality. And I think that the government's really pushing for more liquidity in the markets. So, taking money from equity markets, putting it into more fixed assets in banks. And if you're a long-term investor, I think things are looking better. If you're a short-term investor, you'll really have to measure what you're doing. That's what.
Okay. Well, for everybody's reference, let's just get the tables going. And we have, as I said, paper, pen ready. There are lots of tables on the show today. So first, let's just look at how the rates have moved because you have this whole class of listed securities, listed shares, whether it is listed REITs. So whatever is listed. In fact, even if you look at it, I mean, you'll have listed bonds and debentures. For all of these, class of instruments, the holding period is now 1 year and the long-term tax is 12.5%. The short-term tax is 20%, or in the case of listed bonds, it's your slab rate. So it becomes fairly simple. Let's look at the other aspect. What happens when you get into the unlisted arena or when you look at non-financial assets like property or gold? At a glance, just telling you this, we'll get into details in just a bit, but at a glance, for anything that is non-listed, financial or non-financial, the holding period is now 2 years, 24 months or 2 years. And if you hold it for 2 years or more, then you get the benefit of the long-term capital gains tax regime. And that tax rate is 12.5% without indexation. And that's where the debates really begin. Yeah. All right, we've got lots of questions coming in actually on capital gains, as you can imagine. We have a viewer joining in. Ayush is with us now. Ayush Ray. I believe, Ayush, your question is on listed equity shares or listed equity mutual funds. Tell us.
Hi, my question is related to, has the non-taxable limit for profit booking has increased from 1 lakh to 1.25 lakh under mutual fund and SIPs? And if yes, does it negate the increase in the LTCG rates or it has got no impact on the same?
Okay, well, we really hope, all of us hope, right, that that little buffer and cushion can make up for the higher tax. But let me ask the expert. Mohit, what do you think? How much will it help?
It helps to a very little extent, Surabhi. It increases the ammunition for people who believe in tax harvesting. But honestly, I don't think so. It's a big game changer. For people who run huge amounts of profits, I think their rate has gone up from 10 to 12.5. Yeah. Just the marginal increase from 1 lakh to 1.25 will assuage the matters a little, but it won't like really give you a huge buffer to cool down the tax impact.
Maybe for smaller investors, it's a bit of a helping hand.
Yes, for smaller retail investors, this is definitely a good step.
But Srivatsan, I mean, I guess the market has digested that, right? The point of debate is actually not on listed equities, surprisingly so. What's your sense for listed equity shares or equity mutual funds? Anything you'd like to add here or any advice to viewers?
See, I think on the question that the viewer just asked, right? Like it translates to about a net tax benefit of about 5K. And this is also assuming that you have enough investments to book a 1.25 lakh kind of profit. This requires active, portfolio management and active booking of profits and turnovers. The common man may not have enough corpus to actually take the benefit here. Whereas, like you said, the big bulls, it may not be too much to bother with.
Okay, so this is the least of our troubles, actually. 10% going to 12.5%, because that's not where the confusion is. Let's get to the heart of the debate, and that is property, right? So much has already been spoken about it. In fact, we've got a viewer query coming in on this as well. This is a question from Janali. She's saying, as indexation benefit has been lost now, after the budget, and the LTCG tax rate has been cut to about 12.5%, how much should the average gain be in the price of a property so that the new regime is actually beneficial? She's saying, share some examples. Janali, worry not. I've already put our experts to the job, and they've actually worked out some numbers which can be very, very helpful. But before we get to the numbers, the debate itself, Mohit, good or bad, this new regime in terms of capital gains for property?
Look, Surabhi, there can be multiple takes on it. My personal take is simplification is always better in the long run. Indexation was kind of a rebate which the government was giving to preserve your real value of money, right? It was a compensation against the price rise in the economy. No other asset class was enjoying it. Debt was enjoying it till last financial year. It got taken off. Property and gold were the only two asset classes which were enjoying this intrinsic advantage over equities or over debt or over anything else. And I think government has done a great job in terms of getting everything at par. Will it harm someone? Will it benefit someone? It will all depend on when have you purchased your property and when have you sold it? What has been the appreciation in your property?
Yeah.
Also, one caveat out here. Gains till 2001, as in the value till 2001 has been preserved, which means your indexation or your fair value of property, whatever it was in 2001, the computation starts from there. Till 2000, if you hold an ancestral property, then obviously you need not be worried, because till 2001, your property
price has been sort of preserved.
And indexation was kicking off from there.
Okay. We want to take the examples in, and then I want to ask you really how this is working out. So let's get down to the math and take an example of, a property, let's say a property for 30 lakh rupees that was purchased back in 2009. So let's get the table up on the screen, and then we'll work through the numbers to see what happens in the old regime as well as in the new regime. Remember, the example that we're taking here is a property bought in 2009 at a price of 30 lakh rupees. We're assuming that it was sold this year at a price of 1.5 crore rupees. So you're assuming that the real estate market was really good and you got a great deal when you sold that property. So now let's see how this works out. Now, in the old regime, you have indexation. So therefore, you have an index cost. Basically, the 30 lakh rupees has been bumped up to bring it up to speed with inflation. And the index cost, going by the indices of, the inflation indices which are there, comes to about 73.5 lakh rupees. This is the index cost. How much have we made by selling the property? 1.5 crores. What is the index cost? 73.5. So you just subtract and you come to the gain. The net gain is about 76 lakhs 42,000. The old regime was taxing this gain at 20% with indexation. So at 20%, the tax liability is about 15 lakhs 30,000, give and take. Now let's come to the new regime where there is no indexation. So this is not applicable. There's no index cost here. The sale value is 1.5 CR. Originally, we bought this house at 30 lakh rupees. So the net gain is 1.2 crore rupees. That's a huge amount. But the rate of tax is less. It's 12.5%. So the actual tax liability is about 15 lakh. Now, in this example, you'll see 15 lakh, 30,000, 15 lakhs. So it's not too bad, Mohit. I mean, just going by this example, it seems that why the hue and cry? Why is there so much heartburn? Because it doesn't seem to be making much of a difference. What am I missing here?
Surabhi, the magic and the trick lies in your sale value. right?
Right.
Out here, you have assumed the sale value is 1.5. For someone, it might be 3, it might be 4. For someone, it might be lesser.
True.
And whether you are benefiting from this regime or the regime is harmful to you will totally depend on your sale value. And perhaps
Okay.
we can take that.
So let's take some
different
more scenarios. Yeah,
Yes.
yeah. So we'll do that. Let's take the example of someone making outsized returns. You know, maybe we'll just put those numbers up here where the gain is like, 3 times, 4 times, 5 times. So this is the second example.
Perfect.
Which we are saying, again, same thing, 30 lakh rupees property in 2009, sold it this year, but at 3 different price points. 3 times gain at 90 lakhs, almost a 5-time gains at nearly 1.5 crores and a 7 times gain at 2 CR. So now we've got 3 different variations.
Yes.
So now how does it work?
And the scenario is totally different for all these 3 buyers, right? So if you have sold it at 90 odd lakhs and just made 3 times your original cost, you are actually benefiting, you were actually benefiting in the old regime. In the new regime, you are paying higher taxes.
7.5
and that
lakhs.
will hurt. That will hurt
That's
a lot of investors.
Compared to about, 3 lakhs
Absolutely.
plus.
If your property hasn't appreciated much, Surabhi, then you are actually under stress.
Okay.
And if you're going and selling that out, right? If your property is appreciated by almost 5 times, this is roughly, this will tend to amount to around 10% odd IRR or 10% annualized return. If your property has delivered about 10% annualized returns, you will be flattish. You have neither
Almost
gained nor
14.5
lost.
lakhs of
You
tax in both.
almost equal under both tax regimes. And if your property has given you outsized gains, then you also gain with this budget. So that is double bonanza.
Okay.
basically.
So the 7 times over there, if this property has gone up to over 2 crores, 7 times appreciation, then here the tax outgo is 22.5 lakhs in the new regime.
Absolutely.
Earlier it was over 27 lakhs.
So if you're lucky
benefiting.
with your investment, if your investment has appreciated beyond 10%, you're also lucky with the budget. Your taxes will also be lesser, right? So the trick is if you're making more than 10% IRR or annualized returns, you're actually ending up paying much lesser in the new regime.
So basically the thumb rule seems to be if your property has delivered more than 10% return every year, then you might thank Madam Finance Minister for the
This is a very
new
high
regime.
level thumb rule. It might just vary a little, but
Yeah.
yes, typically around 10% IRR to my mind is the inflection point. You will also have to add surcharge and cess in
Of
these
course,
tax
of
rates,
course,
but yeah, I think those are neutral
Those are
for both.
broad
Yeah.
calculations. Okay. Let's go across to our other guest also and get in his views. What do you think? Do you think this is a fair calculation to go with, that you need at least 10% return for the new regime to be beneficial?
I think that's overall right. We ran a lot of models internally. I think one of the things that we like looking at is if inflation's around 7%, approximately, your property should be appreciating at about 10% annualized. So then you're in a good state. But however, let's take a more, I think, common example. If you bought a property at like 1 crore and sold it after 5 years, and let's say the annualized growth was around 7.5%, the earlier you would have to pay around 3.6 lakhs worth of taxes, whereas now you're going to pay about 5.5. So I think for the common person, for the common Indian, that's going to be a little bit of a shocker. It's a new change. It'll take time for this to be accepted, and I think markets will have to react. Depends on inflation and a couple of other factors.
Okay, but I guess broadly speaking, if you made great gains on your property, then you're better off versus people who are buying and selling a little quickly, hoping for, maybe like a little bit of an increase here and there, and think about taxation because it may not be on your side, correct?
Absolutely. It's a tectonic shift in the mindset also. Honestly, to conceive of an asset class which will not preserve indexed value. Previously, what was happening was because of the indexation, quite a number of investors who were rolling out properties were booking losses and carrying forward those losses and setting off those losses against some other gains, right? So all those things will stop. Property as an asset class, which was, let's say, as an investment vehicle to quickly rotate your money and thinking that your base value is always preserved, I think that notion will go off the window now. You will have to decide asset allocation on the merit of returns and not just on the basis of tax arbitrage.
And that's so important because I remember the day of the budget, there was a hue and cry saying, why is the government incentivizing investment in real estate? The rate has come down from 20% to 12%. But no, now when you run the models and the math, you realize that it's actually disincentivizing short-term speculative investment in real estate. So that's an important lesson to take home. Let's take a break. We're not done, only halfway there. Gold. So much is changing when it comes to your gold investments. Back with that in just a bit.
Let's talk money.
Welcome back. You are watching the post-budget special edition of Let's Talk Money. It's the capital gains classroom where we're trying to go over all the changes and understand what that means for our portfolios. Still in conversation with Mohit Gang as well as Srivatsan Chari. Now let's talk gold, folks, because that also is an important asset class for a lot of people out there. And Srivatsan, I want to start with you with the basic changes because first gold was, getting 20% taxation, but with indexation benefits if you held physical gold for 3 years. Now, I guess that, that time period has come down to 2 years, but no indexation benefit, right? Just go over the changes when it comes to physical gold.
Cool. I think the indexation being cut, the immediate impact was the import duty on gold has been reduced from 15% to 6%. And since India is like a huge importer of gold, this caused the gold rates to fall. And a lot of the hue and cry that you saw around SGBs was, I think, a huge expectation mismatch from an investor perspective. So now it fundamentally translates to, for people who absolutely want to buy gold, let's say for jewelry or something, it's a good time to buy. But if you're already invested in gold and you're now going to see a drop that is obviously going to be frustrating. This will be, a little bit temporary maybe. Now, forward looking, if you're looking to play the market and you're thinking between SGBs and other classes like ETFs, the decision fundamentally comes down to your willingness to hold and the sort of liquidity that you desire. That's our take on it.
Okay, let's just take that point forward. So, Mohit, we'll come to the gold funds and ETFs in just a bit. But up until now, I remember all the shows that we've also done together, sovereign gold bonds were spoken as the best instrument, financial instrument through which you can invest in gold. But now investing in physical gold itself is becoming so enticing, right? With the customs duty cut and this capital gains tax cut. So now what do you say?
So look, I think I would still say sovereign gold bond funds will remain the darlings for gold investors. Honestly, because after 8 years, the maturity is still completely tax-free. Even if you're investing in physical gold, after 2 years, you get long-term taxation, which is 12.5, but you still have to pay that 12.5 tax. Plus, SGBs give you 2.5% interest every year just for holding it, right? The only drawback in SGB, Surabhi, is that the maturity is on a point of date, right? You can't control maturity, you can't redeem.
And you have to wait for the next tranche to come every time.
You have to wait for the next tranche to roll over your holdings out there. So I think that's a little bit of a mismatch out there. But my sense is, in terms of attractiveness, SGBs continue to remain the best form of investing in gold.
But let's also go over what happens if you don't hold that bond, the sovereign gold bond, till maturity. If you hold it till maturity, 8 full years, there is no capital gains tax. But Srivatsan, what if someone is selling, and you can, like after 5 years, the lock-in ends and you can actually sell prematurely, then how will the capital gains tax be applied?
If you're selling it early, you may not get like the fair value. And otherwise, it's taxed at the same rate as an equity itself. 12.5% if long-term, 20% if held for a shorter period.
Taxation. So you just have to pay that flat rate of tax, 12.5%. Got it. So that's sovereign gold bonds. Experts clearly saying that they still have merit because of that added kicker, the interest that you get every year on that bond. But I guess it is actually the other category, gold funds, ETFs or gold mutual funds. That's where a big change is happening for the better, Mohit.
Absolutely.
Because now, just explain how this is going to work for gold funds now.
So look, what was happening was all your gold funds, gold ETFs, even fund of funds, international funds also, you might just want to club it all together. Basically, they were all getting classified as debt because they were not holding greater than 65% in Indian listed equities. So they were all getting classified as debt funds, right? Now, because of that classification, they were getting taxed at slab rates. Irrespective of your holding period, last year the budget changed it. Irrespective of your holding period.
And there was no indexation, nothing, just slab rate taxation.
Marginal rate of taxation at your own slab rate, right? So they were actually all these classes of mutual funds became extremely unattractive, and I think saw a huge exodus plus no new inflows if you see last 1 year of data. But now they are back in reckoning with a full bang. Your international funds, your gold funds, they will all be taxed at 12.5% after 24 months, which is long-term capital gains, and that makes it extremely attractive.
You know, I just want to quickly go over the example that's flashing on the screen right now for viewers as well. We'll explain to you what that table means. Let's get that back up. What we've done is just taken an assumption. Mohit helped us with basic calculations. If you're investing in a gold fund, and let's say you're doing an SIP, 50,000 or rather 5,000 rupees a month SIP running for 40 40 months. The reason we've taken 40 is in the old regime, you had to hold for 36 months to get the LTCG advantage. So just for an apple-to-apple comparison. So what is happening now? Your total investment is 2 lakh rupees because you've let this SIP run for a long, long time. And looking at the appreciation in gold price, roughly speaking, the appreciated price is about 2.5 lakh rupees. So now the gain is the same, but because the tax rate is coming down, the marginal rate of tax at 30% versus now 12.5%, there's a huge benefit in terms of the tax outgo. The tax outgo in this example comes down to about 6,000 rupees odd versus almost 11,000 earlier. So that's where the big kicker comes in for gold funds and ETFs. So make sure you do those calculations when you're deciding how to invest in gold. Mohit, that brings me to the final question, which is on overall hybrid funds. There's this in-between category where equity is between either 35% or 65%, that in between.
Yes.
What happens to them?
So that was a tricky category always, right? It was born last year, it has died this year.
Even before we could understand it and later start investing in it.
So equity between 35% and 65%, they were eligible for indexation after 3 years of holding, which is after 36 months. Now everything is gone. 24 months, 12.5%. That's the taxation which is applicable. There are certain caveats as to if you have bought it prior to 1st April 2023, which is prior to the last year's budget. Then if you go ahead and sell it, depending on the time when you are selling it, there are still certain tweaks and changes, which I would perhaps recommend every investor to do their homework and do it. But if you're buying afresh, life is very simple for you. 12.5%, 24 months holding, it becomes extremely simple.
I think we need another classroom, a separate dedicated classroom on hybrid funds, this in-between category of 35% to 65% equity. What happens if you bought last year? Because remember, the tax regime has changed 2 years on trot for these funds, and they include a lot of popular categories like balanced advantage, multi-asset, a lot of such categories. So Mohit, on television, I'm telling you, you've got to come back next week because this requires, I think, some more...
Absolutely. It's very complicated, depending on when you're selling it and when you have bought it. So yeah, we should.
Super. So part 2 of the show coming up. But before that, let me take some final thoughts with our guests. So Srivatsan, what's the advice? I mean, this is a massive change. People will still take time to understand it. What should investors be doing? Because we look at our portfolios and tax, whether we like it or not, is a huge part of the decision-making process.
I think 2 thoughts. Stay invested for the long term. Don't use tax to make short-term choices at all. That's really what I would leave people with.
Look at that. And he's a tax expert, yet he's saying the same thing that planners say, right? Mohit, I'm sure you'll agree.
Yeah, absolutely. 2 thoughts from my side also. One, I think asset class has to find place in your portfolio basis the merit of return and not basis the merit of tax arbitrage. And second is, I think as investors, everyone should focus on crossing the swamp and not figuring out the crocodiles in it. So you will always have to face some crocodiles when you're trying to cross the swamp. But I think just focus on long term.
All right, gentlemen, thank you so much. That's part 1 of our capital gains tax classroom. And next week, we're going to do part 2, all your mutual fund issues with capital gains tax. All of that will be answered next week. See you again. And thanks very much. Keep those queries coming. We'll see you next Wednesday, same time, same place.
Let's talk money